Hello everyone, it's Alan Ross here, back with another real estate investing video. Today's topic is the top 10 key tips vital for a new person starting real estate investing. It's very vital that you pay attention if you want to get into this industry. So pay attention. The top 10 tips for newbies starting real estate investing. Number one, education. You want to educate yourself. You want to take tutorials. You want to do online learning, take classes, seminars. You want to follow around people who's been in the industry that have credible track records. You want to make sure that you educate yourself because knowledge is power and knowledge is the foundation to your real estate investing career. Number two, mentor. One thing that I strongly suggest is to get a mentor. Mentors usually are people who have been in the industry for a long time and they know the ins and outs and certain things that books cannot teach you. They can teach you a quicker way of doing it. It also speeds up your learning process. So like when you have a mentor, something that you may be a little bit confused knowing that a book or a textbook or an online course or something can't help you with, a mentor can kind of give you the ins and outs and the realistic avenues to answer that question. So definitely get you a mentor. I suggest at least been in the industry for at least 5 years plus and have seen a lot of different various real estate investing aspects. So definitely a mentor. Number three, know your area. This means farming. So this is for people that are just looking for properties. If you're looking for properties, whether it's for a fix and flip or whether it's for a rental, buy and hold, whatever you're looking for, you wanna have a farming area. That's an area. A farming area is an area like within a 2 to 3 mile radius that you're very comfortable with. That you know everyone in that area. You know all of the properties in there, and you keep like a kind of third eye watching it occasionally to see anything new that's happening in that area, like vacant houses, foreclosures. Somebody is possibly like leaving the house or abandoning the house, whatever it is, you kind of know that area like you know your own name, like you know your own self. So that should be your area that you start at. Typically, you have a farm area for about like 2 to 3 weeks. If nothing pops off, or anything happen that you want to happen as far as action and getting deals or getting houses or finding sellers that are distressed to sell, what you want to do is you want to check another zip code and then do 3 weeks on that, and you want to create a cycle for that. So farming is very critical at finding properties, and it's also one of the key aspects, believe it or not, that the person who finds a property is the one who holds the most weight in this industry. Okay, number four is evaluation of the property. Very critical. You need to know how to evaluate a property because there's a lot of different scenarios you can have in any property. Some apply to all, and you can have some where it's a fix and flip, some where it's a buy and hold, and some of it you can actually have both as an option. For example, I have a fix and flip and it's ARV or after repair value, which is based off of the equity. Any fix and flipper is always, they care more about their equity than cash flow. So you want to look at the property in that scenario as far as the equity, how much equity it has in the property. ARV after repair value is based on comparables, which are like homes that has been sold within 0.5 of a mile to a mile of the subject property, and then similar properties, same bed, same bath, same square footage, that type of stuff. So for in this example, for example purposes, you purchase a home and it's $30,000. Rehab cost is $40,000, so the total cost is $70,000, right? The ARV is $130,000. So you sell a house at $130,000 minus the $70,000 of the total cost, and there's a $60K, profit in it, minus the administrative costs or whatever that number is, but approximately $60K less any administrative costs. So in this particular situation, the equity in the house was up to $130,000, and that actually made it a great fix and flip because your expenses was roughly around approximately $70,000. So you know that you have some room in there to flip. Just depending on the rehab costs, etc. So when you're evaluating a property for this scenario, you're going to be like, okay, well, at fix and flip, that's one option. I can do that, right? But then there's a second option. Let's take a look at the second example. This one is a rental or a buy and hold. And typically with buy and holds, you want to make sure that you're looking for cash flow. You're not really looking for equity. But sometimes you can have a combination of them both. But usually it's for cash flow. So for this same exact example, when a couple of things change, the property asking price was $30,000. The rehab cost $40,000. So the total cost of everything was $70,000. Now, mind you, you care about cash flow. You care about your net ROI, which is your return on investment, how much money you're making at the end of the year and at the end of every month. So This one, the ARV, same thing, equity, it was $74,000. So your expenses was $70,000. The ARV was $74,000. So you had a net equity of a positive $4,000. That's your equity build in the property is $4,000, right? So if you were fixing and flipping, this would not be a great scenario, because you're gonna spend more than $4,000 in like a lot of expenses and other administrative costs and stuff like that. So you're not gonna make any money. Again, you won't make any money on that. So it's not a great fix and flip. It's actually, you know, in terms of the equity. But when you continue to go down, you know, the area, we've done our research, we looked at the market and everything, and we see that it's a great rental area though. So that market is renting at the same type of property for $1,000 a month, right? So it's a great rental area, right? So after you subtract your expenses, your net profit on renting a house at $1,000 a month is $500 a month. So you take the $500 a month and you multiply it times 12 months, and your annual income is $6,000 for the year. That $6,000 for the year is your cash flow. And so when you're trying to calculate your net ROI, you're gonna calculate your cash flow plus your equity bill, and you're gonna divide it by your total investment. So cash flow, which was the $6,000, that's the total amount that you made after all expenses for the year. You made $500 times 12 months is $6,000 cash flow, plus your $4,000, which is the equity bill, which is the difference in the equity and the total of the cost of everything. So $74,000 equity in the house minus the $70,000 in the cost of the property leaves you $4,000 in equity, right? So you're going to put that in the equation. So that's $6,000 plus $4,000 equals $10,000. Total investment, same thing, $70,000. You divide your cash flow plus your equity bill divided by your total investment with the $70,000, and you got an ROI of 14.3%. What is typically a great ROI on a rental? It's usually between 10 and 12%. So for this one per se, 14.3%, this would be a great rental property. Some people can say 8 to 10 or whatever, but if you want to really get your cash flowing on a great rental property, you want it to at least be 10 to 12%. So anything in that range and higher, it's a great rental property. So this one is 14.3. So it wasn't a great fix and flip, but it's definitely an excellent rental or buy and hold. So that's the difference. So you got to know how to do different things of that nature as far as evaluating property. So if you're a new beginner, you want to get to the books and get to the equations and learn how to evaluate it when you're going out there in the field to find the property that you want to invest in. Number 5, marketing. Marketing is one of the most critical things you can ever do in any business, not even just real estate investing, but more so real estate investing, because that's what we're talking about. But in order to grow your business in the industry, you want to make sure that you do marketing. So for example, if you're new to real estate investing, you want to do different things like, you know, get drop cards, which are business cards, so you can send them out and show them and pass them out everywhere you go to everybody you know. You want to tell families and friends, you know, that's usually the first ones that are going to support you in your new business endeavors. So you want to make sure that you give them business cards, have them tell friends of friends of friends. You know, you want to make sure that you have an online presence. You want to make sure that, you know, you're dealing with the social media and putting all of your stuff, setting up your profiles and everything, letting people know what you do online as well. You know, you also want to make sure, like with marketing, that you're focusing on what your niche is. That's the key that kind of throw a lot of people off, because real estate investing is it's a vast array of different arenas. You know, I mean, you can go from tax liens to auctions, you know, to commercial property, to multifamilies, to quadplex, to fourplex, to single family homes, et cetera, et cetera, et cetera. It goes on and on and on. So you want to make sure that whatever, you know, you're marketing, make sure that you're focused on what you're marketing about. If you want to market everything, but make sure that you're learning and you're knowledgeable about everything. If you want to market 1 or 2 things, if you just want to be commercial, just want to be auctions, just want to be tax liens, make sure that you find out who those audiences are. You know, send them out little yellow letter postcards and different things, mails and of that nature, to try to get that audience to come back to you, whatever it is. But marketing, at the end of the day, marketing is the biggest, one of the most key things you can do, or one of the things you can learn here, because without marketing you can't grab buyers, you can't grab sellers, you won't know different things about properties at the rate that you want without doing the marketing. So please pay attention to that and take heed to that as well. Number 6, Types of seller motivated properties. So as a off-market investor, as a real estate investor, you want to make sure that you know the different types of, motivated sellers. You want to know those types. I mean, there are motivated sellers that are going through foreclosure, unfortunately, for whatever reasons, they're going through foreclosure and they're stressed financially or they're strapped financially. They need somebody to be a solutionist to help them to get out of that. So that's a type of motivated seller. You also have probate, which is, someone may have inherited some properties or what have you, and they may not necessarily want that property. And so, it goes to probate where it's owned by the heir to the throne or whatever, and they may want to get rid of it and be super motivated to get rid of that property as well. That's another avenue. Divorce, unfortunately, that happens. Divorce rate is very high in the United States. So a lot of times, two people cannot get along. They disagree on some things, and they have to, settle up their assets. So along with everything else comes a house. And in those situations, the house needs to be sold. It needs to be, taken care of relatively quickly. So that's an avenue. Absentee owners, those are landlords from long distance or whatever. They may have property managers or they may have family members looking over their properties or whatever. A lot of times if it's a single family home or, a property that constantly have problems, and you so far away, you can't see it, you don't know what is really going on with the property, but you're constantly spending money on the property for maintenance, whatever issues, an absentee owner, a frustrated absentee owner would be more likely to sell the property relatively quickly because they're tired of the headache. Last thing too, job relocation. If you got an awesome job and they tell you, hey, you got 1 week to move to a different state, that's another motivated seller. They got to get rid of the property and go to the other state and start their job in a week or 2 weeks or whatever. So these are not all, but these are some things that a new investor needs to know and figure out, okay, which one of these categories I'm going to tackle, which one of these categories I'm going to focus on to try to find me some motivated sellers, which are different avenues and additional avenues to finding great properties at a great price. Okay, a lot of times a big issue that a lot of newbies complain about is not having money, right? You don't need money if you know what you're doing when you're starting out in real estate investing. Number 7, no money, no problem. Wholesaling, assignment wholesaling. Just really quick, assignment wholesaling is a process where you get a property under contract from a seller for a price at a discounted price. For example, it could be $50,000, and then you find a buyer, that long as the ARV and all the numbers are correct, you might find a buyer that is willing to buy it at around $60,000, where you have a $10,000 gap spread in between that you collect that as your assignment fee, and it's $60,000. Long as the ARV is a reputable and a good number that the buyer will buy, you complete the transaction all in one contract. That's the assignment contract. But you don't need any money for that. So the key to it is, if you're starting out, usually a lot of newbies start out in wholesaling because you can build your money up that way. Wholesaling, assignment wholesaling. We will talk more about that in other videos. Also, assignment double closing. The purpose of this is when the wholesaler is basically getting a little bit higher than the normal rates of a wholesaler for their fees. So what they do is typically they have the owner that they have the contract by and on one contract, and they have the buyer that they have the buyer on a separate contract. So you close them both at the same time, simultaneous closing. But you might, in this scenario, $50,000 under contract for the property with the owner, and then on this scenario with the buyer, you may even have it for $100,000 if the ARV is like $200,000 or $300,000, whatever. So you do separate contracts at the same time at the closing at the title company, and you get the in between. So it's $50,000, $100,000. You pick up the $50,000 in that transaction. It happens on the same day, same time, simultaneous closing. We will have more videos on that to come as well. Number 9, private money lenders. Everyone need to have at least 4 or 5 private money lenders like in your back pocket. These are like friends, family members, or people who just have an excess of money and need to put it in places and like to go ahead and loan it out. Great thing about private money lenders, some private money lenders are even work with you after they build a relationship with you, and instead of charging you interest rates on a month to month, they may even charge you the interest rate at the end of your flip. And that's how you can do a full flip with zero money down, by having them give you the money and let you borrow the money, and you have a rate that you got to pay them by, but you pay them at the end of the flip. That's zero money down. But definitely get private money lenders in your back pocket so you don't use your own money and you can build up. Step number 10, building a diversified portfolio. A lot of new investors get a little bit intimidated about this, but this is another key thing that you need to start. So when you're starting out, yes, you're going to do wholesale and different things that are zero money down to build your wealth. But once you get the wealth, what do? You want to build a diversified portfolio. That means whether you're investing in fix and flips and stack your money as you go that way, or you're doing rentals, which are buy and holds, where you're renting out things and building your wealth with streams of cash flow every month. Either way, you need to start with one of the two or both to build your diversified portfolio of investments as a real estate investor. In my personal opinion, I feel that you need to do a combination of both. You know, there need to be some fix and flips, there need to be some rentals, and you continue to go until you graduate to how far you want to go. Some people even use those portfolios to launch them into doing, you know, commercial and multifamilies and things of that nature. But you need to build your nest egg, in a sense, until it snowball effects, and so you have the reoccurring cash flow and money, so you can buy bigger things or more of extensions of your portfolio. At the end of the day, you need to start somewhere. So you definitely want to, the diversified portfolio is where you start, whether it's one house, one condo, one townhouse, you know, one fix and flip, no matter what it is. Start building a diversified portfolio once you're able to. Okay, so don't forget to subscribe to our channel. You know, we're gonna be dropping videos twice a week. Don't forget to hit the notification bell, you know, as we're gonna have a lot of videos coming. So we don't want you to miss one video. Not just any video, an Alan Ross video. Thank you.